Is there trouble brewing underneath the hood? Hi, everyone. I'm Maggie Lake, and today I'm talking macro with our favorite cloud bear, Paulo Macro. Hey, Paulo, it's great to have you back on.
Hey, thanks, Maggie. Great to be back.
So, as we speak, the S&P 500 is at record highs. Yields are range bound. Everyone seems ready to finally hit pause, head out for summer vacation. And yet, I sense from reading your Substack that you're pretty concerned about things. Why? What has you worried?
Um, Concerned more longer term. I think it's funny because as I recall, the last time we spoke on your show, I think it was around April 10th or so. So it was just coming out of the hole, and a guy like me who's kind of biased to the more cynical, bearish slanted side of things, or a skeptic. That's probably the worst time to be interviewing because, of course, anything that someone like me says in the hole is going to sound wrong. And here we are at new highs. I remember being pretty concerned, more kind of bigger picture around confidence and like what the contour of a bear market might look like. And unbeknownst to me, we had already had one, and we're already screaming out of the lows. Um, Admittedly, oversold condition, extremely high volatility, like we discussed,
Mm,
required weeks or months to work out, and certainly didn't have new all-time highs on my bingo card. But you can't rule anything out, especially in markets just fed by liquidity the way these are. It just occurred to me in the last sort of 4 to 6 weeks as we approached the new highs that. Um, there's been a confluence of factors, beyond just the standard taco and backing down on tariffs and the obvious drivers of the buying, with retail buying in droves, that the speculative element is fully back.
mm,
We're right back there in November, December, both in terms of price but also behavior. The symptoms of this are everywhere. In fact, I this started as a joke. I used to run a thread that I call Max Stupid, of just like, trying to catalog crazy behavior. And I picked it up again in November, December, and the thread is like in the dozens now. It might be approaching like 100 tweets. And I joked a few months ago before the crash in April that at some point I'm going to sit down and do a coffee table book or
yeah.
something, like, for myself, to just to document this point in time. And then last night I got home and I remembered this all clear echo thread that I wrote on Twitter back in 22 after the lows, where I warned people, once the low is in, the bounce can always run more extreme than you can imagine. And for me, the experience was in 2000 at the height of the Nasdaq mania. The Nasdaq crashed after that March April high,
Mm,
but the S&P then shook it off, and after about May, June, and went on to new highs and actually peaked in September of 2000. And in that window of that bounce back, there were a subset or like select group of names from the tech wreck earlier that year that then mooned out of nowhere. And for me, like, the case in point that I'll never forget was being short Juniper Networks, which recently was acquired by HP. The stock came public at like $5 or $10 in the late 90s, went to like 120, cracked to 60. So you think it's over in March, April of 2000, and then promptly went to 200 plus for that kind of echo boom. And when I wrote this thread in 22, it was, I think, early August. So we had just started to come out of the hole mid-year. You remember the first half of 22
mm.
was like that window where bonds and stocks both went down, and it was like the worst year for risk parity ever. And we were in the first year of what turned out to be, a multi-year bear market in fixed income and treasuries. And I was thinking back to that thread last night and reading it, and I remember what prompted it was this company, like AMTD Digital or something. I don't even remember the name. The ticker is HKD, so I always get it conflated with the Hong Kong dollar. And a chart of this thing shows that, like, it had just come public a week before I wrote the thread, and the stock went from a couple of bucks to $2,500 and was briefly worth, on paper, $310 billion in market cap, making it the 13th or 14th largest company in the world. And I was thinking back to that. I'm like, man, I don't even remember that. That was 3 years ago. Imagine like a name out of nowhere mooning to $300 billion in size, and you don't even remember it because there's been so much crazy stuff since. So I really want to write this coffee table book for myself. Like, this is the crazy stuff that happened. And I just can't believe we're still doing this 3 years in, like, just one rolling crack up to another. So
It's amazing.
for,
I just want to jump in because not only are we still doing it, we're still doing it even with all of the information at our fingertips, maybe because of all of the information at our fingertips, because it's so hard to be able to parse like what's noise, what's real. Even when you have the president tweeting 24/7, it's just like there's just, I think, a fire hose, right? But
yeah,
when you're talking and explaining this, and let me just like make sure that I'm on the same page with you. So you're talking about these periods, and they've happened through history, as you just pointed out. And I love going back to the bubble because I think a lot of people are thinking about that as a point of reference because tech is leading in this way. That you can have these within this dangerous topping period. You think you see the break, and then you have this one last, what do they call it, a melt up or rocket higher before you
right.
have the real downturn. Is that what you feel this feels like to you?
Yeah, I think it'll actually be even harder. What I've started to notice in the last year or two is that everything, when it's kind of finally running out of energy, is forming sort of like a broadening top, like a megaphone. And this is a sign of like a phase transition in the market that like is in the process of changing direction. Like a liquid going to a gas.
Mm,
Um, and so imagine like just a new high, a new low, a higher high, an expanding low, like that undercuts the other one. I use the word flush a lot, like
mm,
where you take out a level and then reverse. And that sort of market would um, really just chop everybody to death, right? Because people are clearly getting bullish again. You look at fund manager survey from Merrill Lynch that came out earlier this week. Cash levels are back below 4%, and people just piled into the market in June. We all know this is the wrong behavior, but the career risk going into quarter end,
yeah.
the the money coming out of people's ears, the FOMOing, not even fear of missing out, more of fear of underperforming,
Mm-hmm.
pushing guys in, but also everything is a function in terms of sizing for volatility. And it's coming from multiple places as realized volatility declines, right? And you remember when we talked in April, I think I mentioned that in those final days where we were going crazy, the VIX, at 60 seemed pretty insane, but the longer dated variance market, think of it as like implied volatility farther out than just the 30-day kind of VIX window, was discounting 40 vols by December 31. In other words, a 2.5% daily move in either direction for 9 months, all the way through D's 31, was what was priced in the market. Like, and even someone like me, who's kind of skeptical of everything in all this, had to agree. Like, this is kind of crazy. Like, it's a little too much.
Mm.
And for me now, like it's almost like we're headed back to the other extreme. Volatility is getting pretty cheap. Skew is cheap, so guys are ignoring kind of the left tail. I think that there's a window here where one of two things happens. Seasonality wise, we're approaching a weak point on the calendar. I think a lot of guys are waiting for the action in September. I think it comes earlier. I think this is going to feel more like a 1998 situation where August sets off fireworks. I come at that from multiple angles. 1/3 of all global conflicts in history have kicked off in the month of August. Clearly, there's pressure underway again in the Middle East and between Russia and Ukraine, and now Trump with Putin. So there is a window on the geopolitical side that's not a key area of focus for me, but just worth a mention. But election year ones, in the context of an incumbent who lost,
Mm.
tend to get shaky starting around the beginning of August into options expiry and maybe even quarter end, like late September. So we're into like a 6 to 8 week window starting at the end of the month where we could see a little bit of fireworks. Does that generate a 5 to 10% kind of meh correction? Could be, probably. Do we get a broadening top and something that we don't even imagine happens that sends us to new lows? I think, ironically, a lot of people were going back to revisit the lows on their bingo card when we last spoke,
Mm.
a few days past the low,
Mm.
including some well-known guys, Paul Jones and Steve Cohen, among others, were concerned at the risk that we could, undercut the lows. Nobody's calling for that now. So maybe that's what needs to happen to
Yeah.
kind of trip up everybody and send us right back there. But I'm not entirely sure that it's time in kind of stepping back and looking at the contour of everything, that like, disaster is immediately around the corner for good. Because I could see us, again, in year one kind of context, going back to making new highs, or at least retesting the highs once that correction is over, because fourth quarters tend to be very positive
Mm.
in a year one. The most risky window in the and election calendar is really the only seasonality that works consistently over time. It's uncanny. In fact, even Jeremy Grantham, Mr. Value, GMO fame, has said that like this is the only seasonality he respects and looks at. Like it's the only voodoo that a fundamentalist would ever ascribe to. And the window that really hurts and that is only consistently negative is always in year two, in the second and third quarter leading up to midterms.
Mm.
So for me, kind of looking farther down the track, it's interesting how things align here for August, September, for us to have a correction or a downswing, or maybe even a test of the April lows, God forbid. But farther out, next year starts to look really sloppy from a couple of perspectives, where like you kind of back the narrative into the seasonality. The first example I could give is the number of anecdotes that I'm getting from people in industry, not tech, but the buyers of tech and the implementers of tech. I'm talking like major banks who are applying their IT people to doing this kind of implementation work of the, but here, build the internal app at Goldman
Yeah.
for this, that, and the other. It is staggering to me how fast this is moving and how underappreciated. We all know like AI is going to eat everything, but like it's underappreciated even inside some of these banks, like how quickly these teams are moving. And we're looking at a significant wave of job cuts within 3 to 5 years. And in a lot of these places that have been working on this stuff for the last kind of 3 or 4 quarters in terms of an implementation approach, I keep hearing stories from them saying, I'll give you an example. Major bank, actually a bank I used to work for once upon a time, is trying to change, and they're late to this, by the way. Other banks have already been doing this. They want to change the way you send a wire transfer, because like if you've ever sent a wire, you have to fill out a form, hand it to a guy at the bank, and then he puts in the details, and if it's international, he puts in the SWIFT code and blah blah blah. Maybe the other bank gets it like the next day or same day, whatever. They have AI right now checking the banker's work. In 6 months, they are going to switch the roles, and they're going to have AI scan your information. You go online, AI puts it into the systems and conducts it, and the human being just checks it. So roles are switched. That's after 6 months. And then in another 6 months after that, if AI is like doing it 99.99999% correct, like the advent of the ATM machine, like there can be an error rate, but as long as the error rate produces a loss that's lower than the cost of carrying all the bodies, they will then fire all the checkers. And so people are literally checking themselves out of a job. And the notion that we will use manual labor for sending wire transfers is gone. This is just one
And
little
it's one
example.
tiny,
Exactly.
because I
You
talk to
scale that
people
up
across
across, yeah,
industry, and it's like, and when they're talking about it, it's not from a sort of societal point of view or even a labor point of view. It's a very sort of like execution point of view, like
yes,
how are you using it? Are you building AI? Are you buying it? Okay. And in the context of one of those conversations I just had recently, someone said the biggest expense for companies, full-time employees. Full-time
that's
employees.
right.
It's like, so, it's really being boiled down. And I get why that's happening from that sort of like job function role. It is my function to do this. But we are not having a larger societal conversation about that freight train that is coming. And it is. And you're right. Everyone kind of knows it, but it's that weird, it's like right in the corner of our eye, but no one's really looking at it.
Yeah. So without naming names, I told the story I just told you to a neighbor of mine who runs an enormous division of multiple lending verticals for one of the largest banks in the United States,
Hmm.
without naming the bank. And he laughed and he said, "Yeah, we've been doing that already for 9 months. We're well underway." Then he goes, um, "I'm actually really worried for the employment base in America, to be sure." He goes, "Within 3 to 5 years, uh, we've been discussing this internally, that we are looking to cut 30 to 40% of our BPO and call center staff." And I said, "How much do you have?" And he said, 100,000. I'm
Yeah.
like, "So you're going to lose 30 to 40,000 bodies in 3 years?" He said, "Yes."
Yeah.
That's one bank. Keep in mind, like these are real numbers, especially when you hear like NFP, payrolls are 100,000. Private payrolls right now are like either side of flat. So 30 to 40,000 from one bank. Like, granted, it's over a few years, but like that's one
But
bank,
we're not
right?
talking 20 years, Paolo. We're talking 3
Yeah, no, it's
years,
now. It's now.
right?
It's
Like
3 to
it's
5.
already taking place. And
It's by the end of the decade.
no
And
mention, no policy mention, no mention of this in Washington. But we could have a whole show talking about this, and I hope more people do, because and we will try to, because it's just complete. It's like talk about driving off the cliff. I mean, it's
yeah,
incredible that this is not like the main policy concern for all of us. However, I take your point that. And I'm just going to time frame this, because we're not
mhm,
talking about short-term payrolls here, because the payroll number was just pretty good. The issue is you're looking out to things starting to get messy around 26. And
yeah,
for multiple reasons, this is just one of them, because you may start to see it. It's not going to be off the cliff overnight, but this is when you're going to start to see, oh, this is kind of steadily sucking payrolls. They're not good, like what's going on, as just one of the many pillars of things that start to get tough.
that's correct. I sorry, I always go off into story
No,
time,
that's
but
okay. I mean, this is super important stuff.
yeah, this is I try to back into like how could like a midterm year look ugly, because 2022 was a midterm year. That was a pretty ugly year, right?
Mm.
So if we were to assume and start with the premise that like seasonality suggests next year's going to be sloppy for equity risk in the US, what would it take? Like how do we back into that negative seasonality? And one of the things that I think of is this sort of white collar slash entry level recession induced by AI implementation, where it's finally coming out of Silicon Valley into the banks, into the corporate world. And slowly but surely, you start to, fire around the edges to preserve margin. And tariffs help things along, because if you can't pass through, or you're going to eat the margin, you're going to try to preserve margin from raw material costs or import costs another way, and that's by losing the bodies. So and I'll give you like another extreme example, because now this calls into question a lot of other things, right? Like I find myself thinking in hearing this from my neighbor. He tells me a story. He's like, we recently ran a project. We needed to write 35 million lines of code for a new platform
Mm.
internally here. And I said, wow, that sounds like a lot. He's like, it's a lot. We budgeted it out as 17 man years of programmer time. So that would be like, 100 guys working 12-hour shifts in India for a couple of weeks, if you do the math. He said, we did it with 17 guys in 2 days. Okay. That's 34 programmer hours versus 17 years of programmer hours. They got the job done in 2 days. And he goes, and then I go, like, so you're talking about mass unemployment in the US in a few years? And he's like, it's going to hurt here, but man, it's really going to hurt in India.
I was just going to say that. I was just going to say the back office that we outsourced everywhere around the world, the globalization part of it.
Boom. And then like that challenges me, right? Because I've had this view, as so many do, that China's ascendance is already kind of not long in the tooth, but like they've gone through their sort of S curve
Mm.
of like commodity intensity and coming out middle income party. Obviously, there's more to go. There's a lot of China that's not developed, but India is sort of like the next 10 years, right?
Mhm.
And when I think about that, I struggle, because that suggests to me that like, well, India is a very crowded long among emerging market managers,
Mhm.
and has been for some time. It's very expensive as far as markets go, and there's something potentially coming that's outside of their control, right? Like,
Yeah.
I don't know. I don't know what to do with it. I'm still thinking it through, but like it challenged me when he said that,
Yeah.
because maybe it's not that simple for India in the next few years. Maybe the next 10 to 15 years belong to India as the next frontier, but it won't come without bumps along the way. So all of these kind of anecdotes aside, I'm starting to see a picture come together where we kind of get the tip of the iceberg on AI implementation next year.
Mm.
Um, we get enough of the U.S. And this comes back to the discussion around dollars and the dollar and fixed income, right? That we talked about in April as my kind of primary points of concern.
Mm.
The dollar really hasn't bounced much. I would have expected that we'd work off more of this kind of hot money short that showed up very quickly. But the offer, especially out of Asia, Taiwanese lifers and others, has been relentless. It literally seems like for them to get their hedge ratios up on all the U.S. assets and corporate bonds and treasuries and equities that they own, they're going to be selling dollars for a long time. And that's just one category of foreigner. Most active management foreigners, family office types, pensions, like, big insurance, sleepy money, what my
Mm.
pal Shrub calls Klaus. They haven't even met yet to decide what they're going to do with their 70% of global equity, US allocation. So far, all I've seen from those guys is new inflows we're doing that at benchmark, which means 65% to the US as opposed to 70, but just on the new money. Like, they haven't even begun to sell yet. And that's crazy because it's already July and we're like 4 months into this kind of shattering of confidence
Mm.
via, Trump's sort of sclerotic implementation of tariffs and handling of economic policy in general. So things are gonna remain very, very complex. So, bottom lining it for your viewers, and we can laugh about this in another 3 or 4 months at how wrong this turned out to be, but I think that we probably roll over in equities sometime around month end. The
Mm.
last week of this month has a lot of discrete catalysts that could either jam us for one final gasp through to new highs and then kind of news failure back down, or otherwise just peak us out. You have the FOMC, the Fed, in 2 weeks. You have the quarterly refunding announcement, the QRA from the Treasury. That's where they look ahead 3 months and talk about how they're going to balance the issuance, how much they expect to issue in bonds versus bills and such. And this is important because there are supply demand dynamics in play around the Treasury market. Like, will Bessent kind of copy what Yellen did and tilt more of the deficit issuance into the bills and away from the long end of the curve to try to keep the long end rate from blowing
Even
out?
though they raked Treasury and Yellen over the coals for doing that.
Correct. Yeah, I call it, like, the song and the Who sang, like, "Meet the new boss, same as the old boss." It's funny though, like, he actually has a point, and I really want to say, like, you know, I try to be impartial about this, but what was egregious about Yellen doing it was the curve was inverted. So, like, you would have paid less interest by issuing at the long end of the curve, and
Yeah.
she chose to do it in the bills anyway, jacking up interest costs, and interest expense for the Treasury, but only because she was playing a substitution game where money market funds would come out of the Federal Reserve RRP and buy her bills. And this was a way for her to catch up issuance without hurting liquidity in the
Yeah.
marketplace and actually engendering some speculative fervor, because the more interest payments you cut to people, the more money they have to spend.
Mm.
And the top 10% of Americans constitute 50% of consumer expenditure. So if you're giving those people 5% on their money as opposed to 2%, like, they have more to spend. So there's a stimulative element to higher rates in the short end.
Mm.
And but the curve was inverted. She should have been issuing in the long end, like, to
Absolutely.
save the taxpayer money. This time around, like, the curve has uninverted. It's not super steep by any means, but Scott has a point. Besson has a point when he says, you know, why would I rush to issue at the long end at 4.5 when I can still place bills at 4.25? Like, I almost sense like what's going to happen in 2 weeks is they're going to say, we're going to keep things as is, but we have incremental deficit until, like, the money shows up from the tariffs. All of that we're going to do in the bills, and it's transitory. I hope he doesn't use that word because
Yeah.
that gives me chills. But, like, it's temporary until the Fed cuts rates, and once they cut rates, we see what happens, and we'll try to term things
Yeah,
out. So,
the
like, there
problem
might be
is
a
if the Fed
dance.
cuts rates, there's no guarantee any of the rest of the curve moves in conjunction with that, right?
100%,
So
100%.
that's it's a gamble that he's and if the rates do go down a long end, you've got to ask why. Like, that's not a good situation if rates are falling. If they do, it's probably
Yeah,
because something's really wrong with the economy, right?
I think that if the Fed, it depends on why the Fed is cutting. Um,
Well,
but there's so much pressure on the Fed in politically today that the narrative is almost baked in the cake. Like, if the Fed were cutting because they saw real weakness in the data, which doesn't seem to be there outside of, like, kind of little crack ups in the labor market and housing that have shown up here, like, and there is room to suggest that this kind of deteriorates by late summer. But retail sales exceeded people's expectations this week. Claims are still relatively low. Like, we could be at the top of the roller coaster. There are reasons to be concerned about the data, but not like overly concerned. Just like that, clearly there's some momentum building for the economy to correct.
mm,
But at the same time, you've got the tug of war of just how big of an impact on inflation will tariffs have. Like, is
yeah.
it in fact like a one-off that we can look through? Like, they don't know yet, right? So their path of least resistance is to do nothing, and Trump's Nash equilibrium is to just pwn them for it, because this way he can blame the Fed for anything that he may have screwed up
Yeah.
in the economy. So it's politically exigent for him to do it. I actually
And he wouldn't be the first president, by the way, to blame the
exactly.
Fed.
There's a playbook for this. Actually, there's so much that reminds me of Nixon in the early '70s. I wasn't there for it, but like I actually think there's a non-zero chance, like a realistic chance, that Trump surprises with a trip to China in the next couple of months. I
Well,
think
this
that's
is
real.
what's so hard. By the way, when you were talking about the economy and the data that's been sort of holding in, even if we're at the top of the roller coaster, this is also what is driving some of the bull case for equities and why retail piled in. Economy looks okay. Some people are still feeling all right. Earnings are holding in. We saw JP Morgan, Goldman with solid results. Taiwan Semi blew it out, 60% profits. So you can see why people who are looking for that can say, okay, well, stocks S&P at record highs. There is some evidence of that. The problem is longer. You're looking at longer and sort of trying to see what's around the corner, and that's where all the concern is.
Yeah, I think correction in the near term, like looking at the next, kind of 2 months, as we get into this kind of fall window, and then we'll see. My we'll see is kind of base casing that we recover, possibly go on to like expand a new top, one last hurrah for 3 to 6 months, and then we run into trouble in 26 with that kind of second quarter, third quarter window.
Yeah. By the way, that
But
26, Paulo, you have not a lot, but good company with that, because several people I've talked to also have put that on the radar as they're concerned. They're concerned about that time frame in particular, and you all have your different reasons. But let me ask you a question.
mhm.
Where do you see the risk most concentrated? Because we're all used to looking at equities because that's what most people, the majority of what most hold in their portfolios, if you're speaking about American investors anyway. High exposure, but as we've talked about globally, everyone said that there's a high exposure to US equities. But we have a lot going on with treasuries, which you just mentioned, and the dollar. All of these things are in play. Where do you see the risk most concentrated?
The dollar. The dollar, for me, especially given the politics around the Fed. I tweeted on in April, right around the time we spoke, a little Jurassic Park, that moment where Muldoon realizes the raptors are out, and he says, like, even Nidri knew not to mess with the raptor fences.
Mm.
And I tweet that picture with, even Bolsonaro knew not to fire the Fed chair. And it's kind of actually a reference back to a thread that I wrote in 22 about the bond vigilantes around the JGBs being raptors, chasing that kind of short yen trade, which worked very well in 2021-22, given they overstayed, NERP SERP in
Mm.
Japan. And for me, I know I said it looked like I say this for effect. I didn't. And I was very clear, like, I'm not saying this for effect. I am convinced at this point that Trump is laying the groundwork to fire Jerome Powell. I said this in April when the kernels of narrative creation and support for the move
Mm.
were being sown, because these things take time.
Mm.
There is a very kind of formulaic playbook for doing this sort of unexpected departure from trend in narrative space. And it was clear as day that he was going to do this, and that the decision was made then to do this. It just takes time to get there, right? Because you have to create buy-in. Now you see there are members of Congress calling for, Powell to resign. Now Tim
Right. And he's
Arias
circling
runs.
the House, because the
Yeah,
Senate's
exactly.
harder, but he's circling the House Republicans.
And he's building the case as well. Like, where even Nick Timiraeus from the Wall Street Journal writes a long expose about how they are going to use the clause for cause to get him out of there, and they're going to use this fig leaf of a $2.5 billion building renovation to
Oh,
do
I
it.
mean, which nobody believes. I
Uh,
mean,
But it's politics for you, right? Like, this is the fig leaf that they will use to fire him. And then I find myself thinking, like, when could that happen? Is it now, in the last week of
will
July?
markets react, Paulo? Do they care, or is it in a way Trump preparing the markets too? Could be, because people could become sort of numb to everything that's going on because there's so much stuff going on.
That's perfectly put. I actually was having this discussion last night. The reason why, he, like, his whole, like, I met with the Republicans, and, like, he even had the firing letter written, and then, like, and the markets tanked. And remember how they tanked also. I think it was Tuesday. It was dollar down, equities down, bonds down,
Mm.
just like in April,
Mm.
right? And it was a clear trial balloon. And within an hour, he had said he denied it, right? By doing this over and over, he is doing exactly what you say. He's inoculating the risk markets such that when it finally happens, hopefully nobody will care. Almost like the back and forth on Iran right up until he bombed them. And then
Smart.
oil opened down on the Monday anyway. You know what I mean? Like there is a playbook to this, and it's been working for him. And so, not to go on too long about this, but I said in April that he's going to fire Powell. I don't think anybody had that on their bingo card.
Mm.
He's going to fire Powell. I'm 98 Delta on this, or he's going to try, and he's going to say it's for cause. And then what happens? When I work through like the sequencing, Powell obviously is not going to go quietly, right? He believes in the institutional kind of
He's
gravitas and
also
independence,
he's
and he's wealthy, so
concerned
he
about his legacy as well.
exactly, and he's also independently wealthy from his past career, so
Mm.
he can afford to throw a couple of $100,000 or a few $1,000,000 into defending his post in front of the courts, and so then this will end up in the courts, and this is where it gets really fascinating because so far Congress has shown no signs that they're pushing back on Trump. I mean, the Democrats, like, I don't even know who's there anymore. The Republicans have all kind of fallen into line behind him, even the ones who like have pause over like separate issues, like Rand Paul made a lot of splash when
Yeah.
we bombed Iran, et cetera.
It's been incredible, actually. And by the way, I'm shaking my head not as a political statement. Anybody who watches all the time knows I have no time for anyone right now in Washington. I'm shaking my head because there is an unraveling of checks and balances that was
Yes.
fundamental to part of the stability of the U.S. economic system and why the U.S. was seen as a safe haven. So
And why we're 70% of global equities and
right.
So
And this is
exceptional and
this is an
magnificent.
out
Yes.
in daylight dismantling of that in a way that very few would have predicted, even when he won his
Yes.
second term.
Yeah. And just to kind of close the loop on this, this will end up in the courts, right? And just the fact that it ends up in the courts creates a showdown where so far the Supreme Court has generally been kind of going along with a lot of the immigration deportation stuff.
Which is another issue of checks and balances.
Yeah, like they're kind of absent, but at some point, like they're going to have to stand up and figure out like what happened here. And this is very Brazil, where if you get an independent, like a judge that goes rogue, like Moraes on the Supreme Court in Brazil, who's very left leaning and sympathetic to the Lula kind of Workers' Party base, and he goes head to head in narrative space with someone as successful in politics and narrative as Trump is, you're going to see real fireworks because then you have a direct institutional clash. I'm not calling for it. I'm just saying the potential is there then for there to be a feud. And
but weirdly, this is all going to transpire. I mean, this will happen sooner, but I think if I'm following your thread, one of the reasons that this is top of mind for you is because this is all political volatility in a place where there's not supposed to be political risk. So now you're layering on that issue, which the market may or may not ignore. But if you get this is not happening in a vacuum, right? So this is happening while you have other pressures on the system feeding in at the same time.
Yeah. And I worry about the dollar in the context of it's not really bouncing, but we're working off some of the bearish length and positioning.
And people thought we were going to see a pretty good bounce here, Paulo. I had a lot of traders and technicians tell me that like it was so oversold, there's no one left to sell the dollar. And
that's
yet,
right. And the offer is relentless, and the selling just continues. I mean, we'll probably work off some of this length over the next few weeks, and we edge a little higher. Could even go on a nice run. I don't take anything off the table, but I don't think the trade is in equity so much. Like maybe we get another mini April where like we saw on Tuesday, dollar down, stocks down, bonds down all together, where it's just kind of like a stop out capital flight type moment. But as Trump kind of inoculates the market with this will he, won't he, over and over again, and it's summer, right? I'm not saying this happens in the next few weeks. There's some people who think he's going to get fired now. I think that he has a little bit more legwork to do here, but the narrative is getting more and more acute.
Watch for other headlines that are more dangerous too, right? Like firing Trump would steal any fire away from any other headline that was going on. And so if there's difficulty someplace else, then that maybe raises the risk that let me ask you a question. Why should people care who are listening to this? Because sort of currency risk, again, it's not something we've had to worry about, discuss in a long time. Why, if the risk is concentrated in the dollar and the dollar is relentlessly going down, and it's fallen a lot this year pretty quickly as far as currencies go, it was a big move. Why does this matter? Why is that a risk for you? It's a big question, I know, but
yeah, and I can a couple of points actually as I think about it. First off, a weakening dollar, not just in relation to other currencies, but against assets, equity prices, and what have you, would be intensely would create a bigger issue for the Fed from an inflation perspective, because it would breathe life into the inflation narrative, whether it shows up in asset prices and the S&P likes it. Amazingly enough, I know it's hard to imagine after we get a risk off moment, like we probably would shrug off the institutional uncertainty created by all this. And you might see domestics rotate more from fixed income into equities, viewing Mag 7 as there is no alternative. Like, this is the safe haven trade,
Mm.
and I'm back in it. Either way, when you're screwing with the value of the dollar, you're probably asking for inflation, and that just makes the Fed's job harder in giving Trump what he wants, which is kind of a Mr. Backfire moment, right? Like, you're going to fire the Fed chair and maybe touch off like a burst of inflation in the second half of this year or early next. And now the Fed needs to address that, and they're not going to cut into the teeth of that unless you completely co-opted the FOMC. I mean, I feel sorry for Powell. Like, I don't know if people fully appreciate this, but like, I feel sorry to the extent that he's a human being. Like, I disagree with some of the mistakes he's made over time. Transitory was like a big mess, but like, can you imagine how many times a day his cell phone or his house line must be ringing with crank calls? Like, these people are crazy.
Yeah.
Like, there's an army of flying monkeys out there who are probably making this guy's life
Yeah.
untenable.
By the way,
And
again, not the first Fed chair to come under that pressure. I don't know if you remember after the financial crisis, but I sort of wondered how Ben Bernanke got through that, because so many people were so pissed about everything and felt like everything they did was wrong. And so, it's like, it's a thankless job. But that's why
yeah,
people go into public service, especially people who already have their right, because they feel like they have to. So disagree with his policies, but these are not easy jobs.
and I would actually take it a step further. One pushback I keep hearing from people is, it won't be so bad if he tries to fire Powell, because the FOMC is a committee and they will all come together. They're all from inside the Feds, and so they will circle the wagons and try to protect the Fed, and protect its independence. And just replacing the Fed chair, even if it's for cause, like, who's he going to put there? Some crazy, like, no, he'll probably go with a Hassett, or one of the two Kevins, or maybe Besson or whatever. I'm like, you're not thinking creatively enough. Like, Trump has clearly shown us that, I mean, he's willing to put like any kind of crazy in the seat if it suits him. Like, his number one priority is loyalty.
Well, I was just going
Right.
to say, we could, for people who maybe, lean that way politically, we could just say loyalists above all. So
Yes.
how do you feel about that? Like, loyalty as opposed to any experience running the Fed. And we should remember, the Fed is the bank supervisor. There's a lot of wonky stuff that you do. It's like very
Yeah.
wonky stuff. You have to really understand the nuts and bolts and the plumbing of the system, because when things start going belly up, it is the people who understand the plumbing of the system that maybe can find a way, but we can talk about whether that's even possible. So I'm just gonna jump in here, because I think that, so the dollar, the devaluation of the dollar, we're talking about why that's so important, and I feel like the dollar, the relationship between the dollar and treasuries is so important here, and both seem at risk. And it seems like the policies are kind of at odds. I don't know. We were seeing them both move together. That's weird. How are you thinking about that relationship? And I don't know, like, inflationary lower dollar is bad, but there's
Mm.
probably also faith and reputation of the U.S. that U.S. assets become less attractive, right? If there's a lower dollar for international folks.
Yeah. I think there's a capital flight redirect, or an ongoing attempt for, foreigners to get their hedge ratios on the U.S. asset pile that they hold.
Mm.
And that will continue. I think the real trade in here, not to seem like a total departure, is in what I call the white metals, silver, PGMs, platinum, palladium, what have you. If for no other reason than, gold still has been working off length for the last few months, had an incredible run. A lot of these things, gold's at new highs or near new highs, historically, but silver still, 10, $15 away from its all-time high set in 2011 and 1980. Platinum, off the all-time highs by, I don't know, more than half. And platinum used to trade at a premium to gold because it's rarer. So I'm seeing these opportunities in the metals from a perspective of alignment with narrative, clear debasement trades, where I don't have to be 100% right on what the bonds will do versus a weakening dollar. Because I'm actually sympathetic to the view that if the dollar weakens enough, bonds might not sell off as aggressively, because the long end of the curve and the dollar are kind of two sides of the same coin. If
Mm,
the long dated yields blow out, let's say to 6, you're going to see the dollar bounce, because 6 is an attractive rate and it creates kind of a vortex of demand for the dollar. So the more bonds sell off, the more in the past we've seen the dollar bounce. So if the dollar falls, you would expect that actually the long end is probably lower than it should be, or otherwise would be. So maybe being short the bonds in a deteriorating dollar environment outside like a window like April, where it all
mm,
goes down together in kind of an acute, like, get me out way. The relationship is complicated. So for me, I try to really keep it simple here. I think,
makes sense.
we're in kind of a fiscal, keep it running hot, extend the cycle as long as possible, rah, like dereg, for big business, corporate tax cuts up the
Mhm,
wazoo. Let's keep the party going. Kind of cyclical value, like with inflation and dollar debasement, like all, all of those things align on the metals. But, does that mean I don't, like, I want to buy gold, or like, no, I mean, gold will work, but the real opportunity is in the stuff that has industrial use, so that you play economic growth and inflation for a burst hurrah, in the context of a weakening kind of dollar debasement story that comes with the institutional fracas of potentially Powell, being pushed out prematurely. So that would be like the key opportunity I'm looking at for the August September window. As overall risk gets squishy, I could see some opportunities popping up in the metal space, and then we'll see. But yeah, it's for me. So, like, to kind of bottom line for your listeners, I think we get an equity correction here in this kind of late summer window of August September, depending on what happens with Powell, or other kind of catalysts in the picture. We probably shake that off by quarter end, and we have a reasonable bounce in fourth quarter. And then I get concerned about 2026, both from a perspective of kind of like, labor market, AI.
mm.
I also, like, socially, I don't get into this much, but I really worry about who gets the hit, because AI seems to be doing its best work at replacing entry level kind of analyst and associate age jobs. And when you talk to, kids in college or grad school, like, they're all depressed. It's almost like the Chinese lie flat phenomenon, where I speak to a lot of these kids and they're like, what's the point? Like, this AI does the job better than I could. And there's kind of a hopelessness that I'm starting to hear in that age segment, like, lower Gen Z, younger Gen Z. But then also, like, if you're 60, 65, and like kind of, the second half of the tail end of the boomers, and you're a few years away from retirement, man, maybe you should retire now, and like you kind of get handed your hat. So like the outside, like the older than 55, 60, and the younger than 30 are the ones who I think are in particular kind of vulnerability window for AI implementation in the next few years. But I'm still thinking this through.
I think that we should all think really hard about that because generationally, I mean, talk about like waves of getting screwed. And I worry deeply about that. And, in the past, we'd worry about, like, I've asked people, is there a concern about social unrest and stuff? I don't even know if there's the energy or hope to sort of take to the streets. And that's even more worrying because you're right. That's why there is this sort of like detachment and that hopelessness word you used, I think, is really powerful. Let's not forget that student loan issue is coming up, right? So God forbid they did take out student loans. Like, it's all coming down. They're not forming households. They're not buying. There's a lot going on that is deeply concerning and should be of utmost importance to anybody in a leadership position. And yet I see nothing. I hear nothing. I see nothing. I know there must be people doing good work on this, and if you're one of them and are doing it, please call us so we can talk to you. But I really, Kyla Scanlon, I'll say, is one person who's doing a lot on Substack, writing from a sort of generational view. If you're not following her work, do so. This is really excellent. But yeah, there's a lot to worry about that, I think, on Paolo. We should talk about it more.
Yeah, no, it's something I'm kind of thinking through. Like, for me, like, the primary focus is always trading and asset markets. But as I
Mm,
kind of fill in the picture around it, I wonder, who benefits, who, gets
right.
most hurt by this. The neighbor I mentioned to you with the 35 million lines of code project. Um, I said he goes, I think 10 to 15 million unemployed in the US in 5 years. And I don't know what they're going to go and do. Like that's the window of transformation that they're looking at when they extrapolate out their different projects just within one bank. And I said, oh, so like this ends in UBI. And it's so funny when you talk to like a geek, like an IT geek who works for a bank, but he's not in finance. He goes, what's UBI? And I'm like, universal basic income. He goes, oh yeah,
Yeah,
definitely.
yeah,
Yeah.
exactly.
Yeah.
That
Like, and I'm like, so,
that
like
dirty word, except we have deficits out the wazoo, right? So, like,
exactly.
that again is an issue. By the way, somebody I was just listening to someone said the sort of the best thing, and you're right, you worry about trading, a lot of our viewers worry about it. Human capital is one of the best investments you can make, right? Like, corporations have known that. Nations, some know that, some used to. So why are we not looking at it through the lens of investment? Like, what do we do? How do we reinvest in people? And what will we all be doing if we're using AI? Like, it's just being talked about from a very efficiency, profit, transactional point of view, and it's not being that other part of it's not being discussed by enough people. And I think it should be. It's a really big risk. So let me ask you, let's end on opportunity and then
Mhm.
and what would make you wrong. So you like the white metals. Sorry for the hard shift away from social, but we're going to do
Yeah.
it. So you see opportunity here through year end in the white metals, sort of outside gold, because there's a gap that they can make up. What about this rest of the world trade that everyone's really keen on, given everyone feels like there's an overexposure to the US? You mentioned concerns about India longer term, but do you like anything rest of the world equity bond wise, or are you really just thinking hard assets and metals right now?
Yeah, well, I mean, it's kind of the same trade everywhere for me in that respect.
Mm,
But to be clear, I would love to see a correction in the white metals into August and September because some of this stuff has already run pretty hard. Platinum has been a missile, palladium's getting in on the party, silver's kind of grinding its way higher. I'd love to, you know, get that kind of risk off into August, September seasonality moment, which
mhm.
would set up a nice what a buddy of mine calls a trampolina, and a bounce off the trampoline. But so I wouldn't. I'm just saying, like, to your listeners, like, don't
Yeah,
go out and like,
load up
don't.
on this stuff.
Yeah, don't timestamp me to this day, and because like then we're just gonna have a laugh at how wrong I was in three
Yeah. By
months.
the way,
But
we are. I just want to say we are recording this on July 11th, and we're going to release it next week. So Lord knows what could happen in that week. So just so we all know, we'll put that at the top too. But
yeah, actually, it's July 18th
what did I
and
just say? July 11th.
11th. Yeah, it's been a
This
week,
tells you
Maggie.
everything you need to know about my July.
No, come on, it's been a long week.
It
But
has been.
I would say outside that, at some point, we're going to push the dollar too far, but I'd rather be in the metals to express it rather than guess is it the yen or the euro or which one works. I have views on everything but loosely held convictions. In terms of foreign markets, to your question, um, I want to like Chinese equities, but whenever China enters a room, profits leave, and all I see is hyper competition. Like the state has even had to make a priority. Like, let's look into this industry and figure out why nobody makes any money because you guys are being so competitive. There's no margin or profitability here. And it's like if profit isn't the primary concern, like it's hard for me to be there on a margin expansion or multiple expansion story. And you can only have multiple expansion if you have margin and profitability and eventual margin expansion and growth, right? But Hong Kong is looking more and more interesting. I was actually surprised to learn a few months ago that Hong Kong was a better performer. The Hong Kong equities index was the Hang Seng did better last year than the S&P did,
Wow.
and it's been kind of a sleeper recovery. So I kind of like the proxy, and the Hong Kong dollar is the world's largest dollar stable coin when you think about it,
Sure.
as my buddy Louis Vincent from GavCal
Yeah,
likes
I
to
like that. I like that
say.
idea. I like that
And
saying too, that when China walks in the room, profits walk out. That's a great, a
yeah,
great way to think about it.
so that kind of, if I'm not going to be in India and mainland Chinese equities are a little dicey, but I can be in Hong Kong, I like that idea. But then as a proxy to commodities in general, as both a debasement trade, but also an economic growth, kind of reflation type narrative globally. And remember that the weak dollar does wonders for the rest of the world in terms
Yeah.
of just breathing credit impulse and monetary impulse into foreign assets and foreign economies. Then you kind of are left with LATAM, which has the commodity slant anyway. Brazil, I wouldn't run out to necessarily buy today either. I've been very bullish on Brazil for the past kind of 9 months or so, and it's worked reasonably well. But we're sort of in a window here where uh, politically, it's a little too soon to be talking about the election for a lot of big money.
Mm.
I have been for the last few months focused on the election, but Lula's the Workers' Party left leaning current president. He's his popularity has fallen so far that it's kind of hard for it to fall even further from here. And I worry that like he gets kind of a dead cat bounce, and we're just starting to see it in some of the polling data. And
Mm.
it's there's this weird thing with Brazilian markets, and I put equities, the currency, and the sovereign market all in the same bucket because it's all one way. If the market does well because people think Lula's out, then animal spirits come back. The economy's starting to improve. The FX lowers, appreciates, which means lower inflation. And then because the economy is getting better, Lula's popularity goes up,
Yeah.
which
He
then
gets the
short
benefit.
circuits the whole thing. Exactly. So the markets have this kind of dance where like you want Lula's popularity to remain low, and this guy not to just. I actually think that it's more likely that he'll decide not to run,
Mm.
which will be really interesting because then it's kind of an open field.
Hmm.
But it's not going to be simple. With Brazil, it's a trading market. It's always going to be kind of choppy, and I would rather revisit it in like another month or two if we can get a little more correction in here.
Yeah.
We've already had some, just to kind of let some of this Lula bounce play through the market a little bit. But that's the trader in me talking. Longer term, looking out kind of 1 to 2 years, absent Lula deciding to run and winning and being reelected, I love the prospects for Brazil because the starting point is so cheap.